So thanks, Eddie, and thanks for everybody that's joining today. Um, Introduction to order flow. So those of you that know Jigsaw, or maybe took a look at our website after seeing the invitation, know that we sell a set of tools for reading order flow. And those tools look at order flow in the very short term, and that's not what we're going to be discussing today. So we're going to keep this within the sphere of applying order flow to day trading, but we're going to be looking a little longer term. And first of all, we're going to look at the theme or the theory or the concepts or the principles behind all order flow tools. And the goal is to remove any remaining confusion about the theories behind order flow. Now, why is this necessary? Well, I've come across many people that use one order flow tool but really have no clue how to use others. So a good example would be someone that uses, say, cumulative delta divergences mechanically, but they're completely lost when it comes to looking at a footprint chart. So they don't fully understand the underlying theory behind the tools. So all order flow tools are simply a different view of the same information for the same reason. And it's my belief that if you understand the theory behind the tools, then that's going to make the use of the tools more productive. And I am looking at this from a complete beginner's view as well as the view of people that just use one or two order flow tools. So after this session, you should understand the mechanics of price change and be able to understand any order flow tool. Now, I know that sounds like a lofty goal, but it is true. Now, that doesn't mean that you'll be able to use any order flow profitably immediately. So generally speaking, order flow tools are a bit like reading a book or riding a bike. The reading a book part is because it's kind of an unfolding story, and the riding a bike part is because it takes a little practice. Now, just one thing to bear in mind, and please follow this, is we're going to discuss the merits of a number of different order flow tools, but that doesn't mean that I use them all, and it doesn't mean that you should use them all. You'll end up with analysis paralysis if you try to use every order flow tool to trade on. And the other goal of this session is to actually give you actionable information that you can take away and start applying to your trading. Okay, so after this session, you will be able to take some things away and use them in your trading. Now imagine all of us has faced the conundrum in this ABCD picture here. We have a price level, the horizontal line, where we're looking to enter a trade. And of course the market can do one of four things. It could fall short of the level, or it could, picture A is it reverses on our line. B, it falls short of the level and reverses. C, it pokes through the level and reverses. Or D, it just blows straight through the level. So what can you do? You could, of course, look at the level and say, okay, I'll put in an order before my level, have a really wide stop, which allows it to poke through and allows me to stay in if that happens. You could do that, but it gives you more risk. You could also scale into a trade. That works. Or you could use order flow to help identify when or if the turn is actually occurring. Now, of course, if you do use order flow in this way, it will keep you out of some good trades. But overall, the effect should be that it lowers the amount you need to risk and it keeps you out of the bad trades. So that's kind of the first benefit of order flow. You can also use order flow to set a bias, and that's very simple. Is when the flow is biased upside, you only take long signals, and when the flow is biased downside, you only take short signals. And I'll show you how I do that later on. Another thing we can use order flow for is to define something called a second entry. Now this is a major element to the way I trade personally. I'm like most people. I have price points I use to identify where a major reversal might take place. And I say might because we never know. And most of the time, I don't enter at that price. I will let the market reverse, let the order flow confirm that it actually was a reversal, and then I'll look for something called a second entry, or what most people call a pullback. Now markets do stair step, and you often get hidden backstops created once a move is underway. Those backstops that kind of stop a pullback dead may or may not be visible on a price chart, but they are mostly visible in the order flow. Now, of course, another way to use order flow is as a pure scalper. Now, I'm not a pure scalper, but every trade I enter is kind of a scalp when I first enter it. I kind of enter like a scalper. And one of the key things to keep in mind about scalping is that every scalper I know still has an emphasis on trade location. So you don't start to use order flow, just look at order flow and kind of ignore everything else you know. You still need to have a way to define a trade location. So people aren't just switching on their trading PCs, seeing something on the bids and offers and hitting it without considering where you are on the day and what the bigger picture is. Okay, so those are the benefits that we expect to get from order flow. But what is order flow anyway? And there's two main components to order flow. The intent is what people say they are going to do, and the actual is what actually happens, what actually trades. So those are the two main components. Now, of all the order flow tools, there's only the depth of market, or the DOM, that shows the intent. Now, as a position day trader, or a slightly longer term day trader than a scalper, you can get away without the bids and offers. You can get away without looking at the intent. But as a scalper, you can't get away without using the intent. It is essential. Now, it's also worth noting that when the market gets into a tight range, you might have to turn yourself into a scalper to some extent if you want to play that range. And for those of you that were trading the ES through 2013, that was pretty much essential to keep building your account in 2013, because that's what the market did a lot, turned into small ranges. At that point, the actual intent becomes a lot more important than the actual at the extremes, because when you get to the extremes, it always appears that the extreme is going to break. So the use of actual trade info is what people are talking about when they use the term tape reading. So a lot of what we talk about today is going to be what is known as tape reading. Okay, and the purpose is we're trying to evaluate right here, right now, what is the market actually doing, and that's why we try to use it at a price level we've got predefined. So we have a price level where we expect something to happen, and order flow tells us, is that actually happening? Now, in terms of perspective, with order flow, you don't really have the kind of concept of higher time frames and lower time frames, although some order flow, obviously the order flow tools you can put on different charts. When we look at price action, many people look at higher time frames and lower time frame charts, but with order flow, the different tools are the thing that give you a different perspective. So for me, I would use cumulative delta to help me set bias, but I would not dream of using cumulative delta for defining an entry. So you can put the tools on any time frame chart, but the way they actually present the information gives them their own perspective. Now, there's one thing on there that some of you might not be expecting to see on a presentation on order flow, and that is the volume. So I do believe that volume is an integral part of reading order flow, and we are going to include some looks at different ways of looking at volume as well when we look at the order flow today. So here's a question that's on everybody's mind. Why does price move? Now, different people have got different answers to this. Now, when I say why does price move, I don't mean why are people buying here or why are people selling here. That's a completely different question. I mean, why does price move around at all? Okay, why doesn't price just stay where it is? Now, some people will say price moves because there are more buyers than sellers. Now, the market, it just purely exists to match buyers and sellers. So a trade cannot take place without a buyer and a seller. Now, in a way, this could have you thinking that order flow is total nonsense. Because why would you analyze a flow of orders when every buy is also a sell? Because a buy cancels out a sell. One cancels out the other, right? Okay, but it's not really more buyers and sellers. Now, some people say it's supply and demand that makes price move. Well, that's possibly, but it's not in the traditional sense of supply and demand. There's no scarcity for contracts in futures markets. They actually get created and destroyed as trades occur. Another answer we can get why price moves may be more aggressive buyers and sellers. Well, that is a little bit closer to the truth. But perhaps the truth is it's less patient buyers and sellers. But the real question we should be asking ourselves, because this is the key to order flow, is what stops price from moving? Okay, so why is it that the ES doesn't trade at 1580 1 second, then 1260 the next second, then 500 the next second, then 1850 the next second? And the answer to that question, what stops price from moving, is also the key to reading order flow and understanding all order flow tools. And the key to why price moves, or why it doesn't move around all over the place, is the consumption of liquidity. Now, what is liquidity? We always hear this is a liquid market, or it's not a very liquid market. Liquidity is the availability of the other side to trade with. So if you're a buyer and you're buying at market, it's the availability of a seller to trade with. Now, when you trade, you're either providing or taking liquidity from the market, depending on the type of order you use. So liquidity is limit orders, it's bids and offers, and for those of you who aren't used to that terminology, it's your eyes glazing over as I talk about bids and offers in my explanation. So I'm not going to talk about bids and offers initially, because a lot of people have conceptual issues with it. They can't match a bid with buying and an offer with selling. So we're going to talk about floors and ceilings. Okay, so what we have here is a picture of a building, and it was a building designed by me, and it's got no stairs and no elevator. Okay, so imagine that this building is the market. Okay, and imagine that we're on the top floor here. Okay, now on the top floor, what we've got above us is we've got a ceiling above us, and we've got a floor below us. To move down to the next floor, what do we need to do? We need to break through the floor below us. Okay, and the market does exactly the same thing. So the floors and ceilings are limit orders, and these limit orders need to be consumed or eaten by market orders before we can move through a level. Okay, so to move down, we need to eat through the floor, and to move up, we need to eat through the ceiling. Okay, so at this point, we've eaten through a floor. Sell market orders have eaten the buy limit orders, and we've dropped down. Now, also at this point, is it easier for us to move down or up? Okay, so look at where we are. We have momentum downwards, but is it easier for us to move down or up here? Okay, now this isn't a trick question. Okay, it is easier for us to move up at this point because there's a bloody big hole in the ceiling. Okay, there is nothing above us to eat. The ceiling is not there. Okay, and that's another key concept of order flow. Okay, because what will happen as the market moves down, we break through the floor, and that effectively leaves a hole in the ceiling above us that needs to be repaired, and we break through the floor, and the ceiling needs to be repaired, and we break through the floor, and the ceiling needs to be repaired. Okay, once that ceiling is repaired, it's no longer easier to go back up than it is to go down. Okay, so that's how the market works. The market effectively has floors and ceilings, and price can't move until the floor has been consumed or the ceiling has been consumed. Right, so resting orders. Okay, The floors and ceilings, what are they? Okay, so if you've ever looked at the dome, okay, you have seen the floors and the ceilings. The bids here represent the floor, and the offers here represent the ceiling. Okay, now some people say offers and some people say asks, and I've got a horrible feeling I'm going to use those interchangeably through this webinar because I never use the same word in 2 consecutive sentences. Some people also call these resting orders because effectively they just sit there until somebody hits them. Now, different domes or different depths of markets show different amount of levels. This is the Ninja Dome, and it only shows 5 levels of bids and 5 levels of offers. And for those of you who are counting the numbers and say I can see 6, it's because Ninja also shows a total. Okay. On the buy side, when we look at the floors, there is liquidity below those 5 levels. There are floors all the way down here. Okay, you just can't see it because the platform doesn't display it. But there is no buy side liquidity, there is no bids, there are no floors above you. Okay, on the sell side, the ceilings here, we show the 5 ceilings. There are more ceilings above us, but you just can't see it because the platform doesn't display it. But there are no ceilings below you, which is pretty much the same when you're in a building. You look down and it's all floors. Okay, now this is important because it means that as we move upwards, we move up into areas where there are no existing floors, but where there are ceilings. Okay, when we move down into areas where there are no ceilings, but where floors do exist. And that means that when price moves, a relative liquidity vacuum, we'll call it, is created beneath you. Okay, so as we move up, a liquidity vacuum is created beneath us as we move into an area where these floors don't exist. And it takes time for the floors to build up in your wake. And the same thing on the move down. In a move down, a relative liquidity vacuum is created behind you, above you, as it takes time for the ceilings to build up behind you. And spotting those liquidity vacuums where price pulls back because of a lack of liquidity and not because of counter trend trading, that presents opportunity. This is one of the ways you get your second entry or your pullback trade. Okay, and I'm going to show you ways to do that exactly later on, but for now just remember there are no floors below you and there are no ceilings above you. There are no ceilings below you and there are no floors above you. Okay, and here is another way to imagine the liquidity picture. As you move up, bids get thinner, and as we move down, the offers get thinner. Okay, obviously as we're moving up, bids get thinner and offers get thicker. It's going to be harder to maintain that upward momentum until these bids have had time to thicken up again. Okay, now this brings us to another important point. At an area of resistance, the ceilings are going to be really, really, really thick. If you look at the dome and you look at the numbers on the dome, the offers are going to be 1.5 to 3 times the size of the bids at an area of resistance. Now, if you're not sure whether a level that you're looking at is one that other traders see as a resistance, this will actually tell you. So if you have a level marked off on your dome where you think the market's going to turn around and it doesn't, and you don't see thickness up there, then there's not many other people looking at that level. Now, as you get to resistance, the offers are going to be stacked, but the thing is, it does not mean that that level is going to hold. Okay, and it's the same at the lows with support. The bids will be stacked at any valid support level, but again, it doesn't mean the level's going to hold. It's just the way the market works, like a phenomena of the market, I guess you could call it. Now, very often, as price trades towards those thick floors and ceilings, and we get there, they just suddenly pull out of the way and the level breaks. Okay, so that is actually the end of the theory. At any time, the market doesn't have a price. So if you think about the price, I mean, the ES is 1841.50 now. That is actually the last traded price. The market any time has actually got two prices. It has a floor price and a ceiling price, which is the inside bid and the inside offer, with a minimum one tick difference between the two. And that difference obviously is known as the bid offer spread. Okay. Now, market orders consume buy side and sell side liquidity, which is also known as limit orders, and which we're also going to call floors and ceilings. And when there's no more ceiling to eat, more buy market orders will start eating the next ceiling up, and price will move up with it. Okay? When there's no more floor to eat, price will move down and we'll start eating the next floor down. And all order flow analysis is effectively simply a variation on this theme. Okay? The other thing we have to remember, as we move up, a relative liquidity vacuum builds up behind you, and price can momentarily collapse into these vacuums before continuing up. And those vacuums present short-term opportunities, and we're going to learn how to spot those soon. Now, different players work on different time horizons and take different amount of times to get their orders in and to fill those vacuums. Okay, but as that process goes through, as those vacuums fill in, that creates a line in the sand behind a move, and that is what supports price as we step up. Now, one of the things as you look at order flow, you should always keep an eye in the rear view mirror when you're using order flow. So don't just look ahead of yourself for obstacles like large offers above you or large bids below you. Also make sure you keep looking behind the move for these vacuums and for these lines in the sand that will build up and will support you as you move up. Okay, all this we're going to look at soon. Now, can I just ask at this point, does anybody have any questions about what we've covered so far? Yep, I'll carry on, and then we can also always stop for those questions in a short while. Okay, go on, sir. No, not with the cumulative delta. I mean, in terms of spoofing and HFTs, I put very little emphasis on the bids and offers on the dome. It's probably the least important piece of information. I do use spoofing. I do look for instance, if the market's moving up and I see huge bids below me in a move up, I will expect the market to pull. But even with order flow, you're in a different space from HFT machine trading, literally to the extent where I will be watching order flow at a single level for 2 or 3 minutes to make a decision to make a trade. So it doesn't screw up with cumulative delta, but that is market dependent. You know, on a market like the ES, a lot of people are using market orders to enter. But anyway, we'll answer that question as we move on. Well, market orders and buy stop orders are both types of market orders, and they are both consuming liquidity. We're gonna and for the next question on volume profile, as we get to the later slides when we're actually talking about volume at price, we're actually going to make those things a little bit clearer. Yeah, absolutely, absolutely. And we're going to look at as I said, we're going to look at the volume flow profile later on. But also, if you look at I think somebody posted a link earlier on to the last webinar we did, Trading Without Charts. I go into a lot of detail on that in that webinar. Yep, about that, yep. Okay. So if we think about what we've looked at so far, big question is, well, so what? I mean, this is all theory, right? How do we put this into action? What is the benefit of understanding this liquidity consumption model? Okay, so let's just consider a few implications of what we've gone through so far in terms of things we regularly see in the market. Okay, now one of the things we regularly see are spikes versus churns, or rapid move up versus slow grinds up. Now lots of people are going to see a quick move up in the market and they're going to equate that to strength. But if you consider the liquidity consumption model, if you think about floors and ceilings, we know that a rapid spike up is going to create a larger vacuum behind it. Now, on the other hand, a market that just grinds, just a few ticks, and a few ticks every few minutes, is often considered weak. We all see this grinding action, where it just grinds, trades, tick up, grinds, trades, tick up. That grinding action is actually a sign of strength, because the slower move doesn't have the same liquidity vacuums building behind it, because it's moving up slowly and those vacuums have time to fill in. Now, grinding moves are also signs that the market actually likes to trade at successively higher prices, and that's price acceptance. So grinding moves can be hard to trade, because when the market grinds up, you don't get a pullback. Okay, but once you understand that a grinding move is actually a sign of strength, it makes it more psychologically acceptable to just jump on board and move like that. Now, as we said, retracements or pullbacks can be spotted by a lack of participation in any counter trend move. Okay, so the market might move down in an uptrend, but if it's because of a lack of liquidity below, a vacuum, then the volume and the delta will not be significant in that pullback. Now, part of the reason that markets have a tendency to step up and down is the fact that it takes time for liquidity to fill up in the wake of a move. Now, of course, you do get perma-faders who can't stop themselves from shorting every move up and buying every move down. Intraday, everybody that has bought, every intraday trader that has bought a contract, once they're in position, they're people that have to sell to unwind, and of course that is one of the causes of pullbacks. Okay, and sometimes when the market pulls back, there is a bit of selling, and sometimes the market actually needs to pull back to actually shake out some of these people that have bought and shake out these future sellers. Okay, so as you move up, you are gathering future sellers, and you often get to a point where you just need to offload some of those future sellers before the market continue moving up. Okay, so when we do step back to a point where the liquidity is filled in, we might see a little bit of selling, but we should still see a very big difference between the selling in the moves up and the selling in the moves down. Now, we've got a feel for the theory of the order flow, so let's consider the implication of that model when it comes to reversals. Now, when I talk about reversals, I mean major reversals and minor reversals. Major reversals being the ones that initiate a new trend, and minor ones being the pullbacks. Now, based on what we know about liquidity and liquidity being consumed, we can identify just 3 elements that will cause a reversal. Now, not all reversals have all three elements, but all reversals have one or more of them. Okay, and the market can only reverse with these three elements, and without them it is impossible for the market to reverse. Okay, now some of these elements are going to be easier to spot in the order flow than others. So let's just consider these three elements one by one. Now, for the sake of simplicity, I'm just going to talk about a long to short reversal and presume you can flip this around yourself from short to long. So the first element of a reversal that we may see is something called absorption. Okay, now this is where the buying continues, but the ceiling doesn't break. The ceiling will either be too thick when we get there, or as buying eats the ceiling, we see more limit orders come in, and the ceiling is actually building up as the buying is actually consuming the ceiling. And this rebuilding of the ceiling as it's being consumed is what's known as an iceberg order. So in terms of being easy to spot, absorption is the easiest thing to spot. It's the easiest sign of a reversal to spot. One of the reasons it's easy to spot, and this kind of harks back to the HFT question, is it takes place over a decent amount of time. Now, on thicker markets, it can take many minutes for this absorption to play out. So what it means is that the offers or the ceilings or the sellers are stepping in and absorbing all the buying, and the buying is no longer able to make the market move up. And eventually what happens, the buyers give up or just run out of money, basically. In some cases, you will be able to actually join the price that the ceiling is, or the ceiling price effectively. You will be able to join the offer, okay? But that really does depend on the market. So you might see the absorption. So if I see absorption on the offer at 39.25, I might see that, know that the market's not going to go up any, or suspect the market's not going to go up any further, join the offer, not get filled, and see the market go down 10 points. Okay, so in some cases you're going to be able to join the market at that point, but it is market dependent. Okay, on the treasuries, yeah, when you see the absorption, joining the offer is quite often possible. On the S&Ps and thinner markets, joining the offer, generally speaking, doesn't get you filled. You're absolutely right about the trade, but usually it goes away without you. Okay, so that's absorption. The second element that we may see in a reversal is buyers fading away. So this is where we get to a price and just nobody wants to trade that price. Okay, sometimes that's a gradual change. So we might get 1,000 buy market orders, it ticks up. Then 600, it ticks up. Then 300, it ticks up. Then we get to the next price, 50 trade, and we're done. Other times, you're going to have regular trading at one price, and then you tick up to another price, and there is just nobody that wants to trade it. Now, ultra thick markets, like the treasuries, might just hit this price one time. So you go on the treasury, you might get to a price, nobody wants to trade it, and you don't get there again. The ES tends to go to that level a couple of times. Okay, and each time, either no trades or just a pitiful amount of contracts trade. So don't hit into the market. Don't feel you need to hit into the market. Whatever market you trade, be aware of whether it comes back to these prices. Don't feel you need to hit into the market. You see it tick up 50 trade, it comes down, you go short. That's not really the way to do it. Okay. Now, it's fairly easy to spot this, but you often don't have the luxury of time that you have with the absorption, and markets do often take a pause, so you need to be looking for the buyers fading at a key level. You shouldn't be looking for it in the middle of a trading range. Okay, and there is a time element to it. It takes time for the buyers to realize that nobody else is buying anymore. Okay, once the buyers realize that, then they're going to start to unwind, and you will see sellers coming. Okay, now the third element of reversal is sellers coming in force and the market rolling over. Now, this is where you don't so much see buyers fading away as just getting to a level and suddenly sellers start hitting it aggressively with size. And many times this is going to be after the absorption, after the buyers fading, but other times it's going to come out of the blue with no warning. Now, you'll most likely see sell market orders in total to be between 2 to 3 times the amount of buy market orders when this happens. Okay, so you will see an irregular or an excessive amount of selling compared to the buying. But this is hard to spot in a timely manner. In other words, by the time you spot this, the market's going to have ticked down a couple of ticks, 2 or 3 ticks. Now, at that point, you can decide to get in at a, in quotes, worse price, which is effectively trading a good price for confirmation. Okay, that doesn't make it a worse trade that you get at a worse price because you're actually paying for that confirmation effectively. Now, of course, sellers stepping in is also going to help you confirm a short trade after you've taken the trade. Okay, so if you see the absorption at a high and you go short, then after you've gone short, you don't just forget about order flow. There's no law that says order flow can only be used for order entry. Okay, order flow is an excellent way to confirm that a trade is actually going your way. So if you go short on absorption, you're waiting to see the sellers step in. And if the sellers don't step in, then you need to think about maybe the premise of the trade wasn't that good. And similarly, it's also a good way to tell if the order flow is against you when you enter a trade. Okay, so order flow, don't just think about entry. Think about entry. Think about just after your entry. Yeah, wouldn't you like, if you're in a trade in the ES and you're a position day trader, sure, once you're 2 or 3 points into profit on a trade, you don't really need to be so aggressively focused on order flow anymore. Now, just to reiterate, these 3 elements of a reversal, they're not mutually exclusive. Okay, you're often going to see more than one of them, but you will always see one of them with every reversal. Okay, so what if you actually miss a major reversal? Well, as I said earlier on, for me, missing a major reversal is a good thing because I am of the opinion that you should miss a major reversal. I meet up with a lot of retail traders, and 90% of the ones I meet that are losing are what I call perma-faders. And it's like a disease. The moment they spot the market is moving up, they're trying to short it. And then when it finally does start to reverse and move down, they start looking for a long trade. So for me, I'm fairly good at estimating where the market may be headed. But I'll usually have 3 or 4 potential areas where traders will offload and potentially start trading the other way. Okay, so I don't fade all of these levels because trading against the market is always a lower probability than trading with it. Plus, I've got 3 or 4 levels. Should I just fade each level every time, knowing that only one of them is going to work out? Now, based on what we know about price action and order flow, we can start identifying which moves are reversals and which are pullbacks, and use that to set our bias and then look for a second entry. So how do you know that the last counter trend move was a reversal and not a pullback? Okay, and I think this is one of the things that you can take away today. You'll find this very useful. Okay, so the things that you're going to tell you if that was a reversal or a pullback. First, the move occurred in an area you actually expected a major reversal. Okay, that's one of the first things you look for to tell if a move is a reversal or a pullback. Secondly, the delta or the footprint accompanying the move is significant. Okay, and we'll look at how to spot this shortly. Third, the volume accompanying the move is significant, and also the number of ticks in that pullback, in that leg, in that swing is also significant. So let's say the ES, and I am an ES trader, so I don't talk about other markets when I'm doing presentations. If you want to look at other markets, you're going to have to figure out how to apply this yourself. But anyway, let's say the ES had moved down 8 points, and now we see an upswing with significant delta, significant volume, and a larger number of ticks than the pullbacks on the way down. And it's also in an area where we thought it might be a logical place to reverse. At this point, I personally don't have an entry, but I do have a new bias. Okay, I do now have an upward bias. So now you wait for it to drop back down and for the floor to form below you so you can actually get in with limited risk. Then you look for the absorption, the sellers to fade away, or the buyers to jump in, the three elements of a reversal. Okay, now order flow accompanying a pullback should be weak. You should see a smaller amount of delta, lower volume, lower swing size. Okay, now of course you don't know the full size of any pullback till it's over, so I'm not claiming I know how big a pullback is before the pullbacks actually complete. Now these are the second entry trades, and one of the things about the second entry trades, if you're still a perma fader and you're always trying to take like the hero trade to fade the high and the lows of the day, the second entries, the pullbacks, do absolutely have less profit potential per contract, but they are trades in an area that is less crowded. So when a market hits a prior high, there are lots of people looking to enter there, and lots of people looking to enter a breakout long and to fade the high. Okay, and the market gets pushed around and people get pushed out of position. If somebody wants to establish a really large position, then a major high or low is an absolutely excellent place for market manipulation. Getting people to buy so that you can sell to them, or getting to people to sell so you can buy from them. For the minor reversals, there's a lot less people looking to trade at that point. You don't have the same sort of games being played, and the order flow is a lot easier to read just because of that. Okay, so I don't want to be too preachy with second entries, but I would like to think if you find yourself always fading moves and always getting run over, then you might want to think about just using the major moves to set your bias. Okay, now what we're going to do now, we're going to start looking through some of the tools, the most commonly used order flow tools. Yeah, absolutely, absolutely. Yeah, possibly, but effectively, Vasi, if you tune in here on a Tuesday and a Thursday at it's 9:30 Central, we do it right, Eddie. We actually do that live. We actually go every Tuesday and Thursday. We take a pause in the market and we actually go through trades that are setting up based on all this stuff as well. So we can do that, but be aware I've actually been in bed tonight. I haven't traded at all today. I was in bed because of this webinar. Yeah. I don't trade news at all. I mean, I do, I have done some studies of, where liquidity is sitting, and often, you can study where liquidity is sitting and look at the market going back to those points off news events, but I just don't trade news at all. I'll wait for it to unfold and then start trading afterwards. And again, I use volume profile. I will let the volume profile build up. So if you go and look at the Trading Without Charts video we did, you'll have a better understanding of how I do that and how I let areas build up before I trade them. Okay, so yeah, what we do. So what we're going to do now is we're going to start looking at the most commonly used order flow tools and kind of try and look at the pros and cons of each. So first of all, we're going to look at cumulative delta. And if you haven't seen that, it looks a bit like a price chart, but it shows buy market orders minus sell market orders. So buy market orders should eat the sell side liquidity. It should eat the ceilings and price should move up. So we don't see the ceilings, but we know that they're there, right? We know that that's kind of the floors and ceilings have got to be there. Now, on the cumulative delta, absorption is characterized by the delta moving up, but the price not moving up, okay? And that is traders getting trapped. Still, the cumulative delta is a bit too zoomed out, or it's a bit too high level, in my opinion, to get a good handle on short-term absorption. So most of the time, when you see the absorption on the cumulative delta, the amount of buying that has been absorbed by the sellers is quite huge. And when you see a huge amount of absorption, the end result is usually that the ceilings get consumed and we get nice pop-up as those sellers bail out. Okay, so you do want to see sellers absorbing, but you also need the buyers to stop buying, right? Because even though the sellers are absorbing, if the buyers carry on and buy 30, 40, 50, 60,000 contracts, the sellers are not going to hold that down. And the kind of, when it becomes obvious on cumulative delta that sellers are absorbing, you're already talking 5, 6, 7, 8, 9, 10,000 contracts of absorption. Okay, and that is to the high end. Now again, buyers fading away is also a little bit less easy to see on cumulative delta because it is a zoomed out view. Sellers coming in is fairly easy to see on cumulative delta, but by the time you see it on the cumulative delta, as opposed to a short-term order flow like footprint or time and sales, the market's probably already going to have traveled quite far. So my opinion is the value of cumulative delta is in setting bias and identifying these liquidity vacuums or pullbacks. Now, very thin markets like crude oil will also fare less well with cumulative delta because the use of market versus limit orders is different on crude oil. Okay, you'll see on crude oil, you're going to see long periods of the cumulative delta diverging from price because of that. So it's really not very good in a predictive sense. Okay, so this is not a particularly cherry-picked chart. I'm going to show you two charts, cumulative delta. Some of the action is going to be a little bit ugly, but then some of the action is a little bit ugly on an average day. Now, just go through what this chart is. This is a 900 tick chart. There is nothing magical about 900 ticks. I use 900 ticks personally because it shows about half a day's action on the ES. Now, if the ES slows down, like at a holiday period, I'd change that 900 to 600, just because the 600 would then be showing about half a day. Now, the reason I use a tick chart as opposed to a time chart, time-based chart, is the tick charts tend to show more intraday swings, and I'm more interested in the swings than the time the action occurred. Now, the white numbers here are the number of ticks in the swing, okay? The blue numbers are the number of contracts in a swing. Now, I personally don't care about individual price bars. So you can see the price bars here are kind of dull grey, but I do care about the swings. So basically what I've got here, I've just got the swings highlighted. Okay, so just to let you know how these things are coloured here, okay, you're going to get a green bar here on a swing up, okay. And by the way, this is a free indicator that's showing the swings here. It's not something I sell. Okay, so the swings are going to be coloured green if there's a swing up and the number of contracts traded in the swing up is greater than the last swing down. Okay, And we're also going to colour green if it's a swing down and the number of contracts traded in the swing down is less than the swing up. Okay, so in other words, it stays green if the volume is to the upside, and it stays red if the volume is to the downside. Now the chart below, in the bottom half of the frame, is the cumulative delta. Okay, so that kind of explains what you're seeing on the chart. So let's look at this first swing down. Okay, we've got a high of around 1359 here, and we end up moving all the way down to 1348. Okay, so as well as the cumulative delta, we're also going to take a look at the volume and some of the other things that we've identified as being essential to spot a reversal. So the first move down, okay, we moved down, we traded 48,000 contracts, and we moved down 12 ticks. Okay, then we move up 5 ticks with 4,000 contracts of volume. Okay, so that 5 tick move up is almost half the size of the move down, but it has 1/10 of the volume. Okay, so that is effectively a liquidity vacuum. That is not buyers stepping in, a bunch of buyers stepping in and buying the market up. Okay, now also if you look down at where we came off and we did the first leg down, the 12 ticks down, we can see the cumulative delta roll over. But if we look at the pullback up, the 5 tick pullback up, we can't see anything on the cumulative delta. And again, that's just indicative of the fact that there weren't really more sellers than buyers in that pullback. It was just effectively that there was no ceiling. Okay, and the market just kind of got sucked back up into there. Okay, if we look at the next leg down, we've got 57,000 contracts traded, and then the next pullback up, 17,000 contracts. Okay, and again, look at the delta on that pullback. It's simply, there's no, we're moving sideways a little bit, but there's really no delta move there. Okay, now it's the reversal in the delta that tells you to switch your bias. So we can see a reverse in the delta here, and we can see a reverse in the delta there. Now on the S&P, you're normally looking for the delta to shift 10,000 or more contracts before you change your bias. Okay, so you're looking for a 10,000 shift in delta for reversal, and you're looking for no shift in reversal for a pullback. Okay, you're looking for no shift in delta for a pullback. Okay, so let's look at the upswing. We've come down, we've made a low, we've now got a high and a low for the day, and we pushed back up. So we're down at 1348, and we pushed back up all the way to 1358, which is 1 point below the high of the day. So it is an area that we're targeting, and effectively what we're seeing here, we're seeing it falling short of the high of the day. So as we move up there, we can see a huge push up in the volume, in the delta. We can also see with that swing up, we've got a huge amount of volume in the swing up, and we can see the swing size, 31 ticks, is fairly big. Now, there really isn't much of an opportunity to get on board a second entry, okay? Not based on the chart. There's no pullback, okay? Although there is something called a volume cluster in the middle, and we're going to talk about that a little bit later. This first pullback here doesn't actually look like it's much of an opportunity because, eventually the market doesn't go up that high, and we are quite close to the high of the day, okay? But it's clear, if you look down here, that the delta doesn't shift down, and also the volume isn't supporting that as a reversal down. Okay. And now we're going to look at the move down from 1358 to 4750. Now note that in this case we do have the added confirmation up here that we are reversing off a known area. Okay, so this is a failed attempt at the high of the day. Okay, and we start off with a 70,000 push down, and we start off with 19 ticks. So we can see with that leg down, we've got a lot of volume and a lot of ticks. Okay, then it retraces over half that move with a lot less volume, and again, if you look down at the delta barely moves. Okay, and as we move down through the daily low all the way down here, we can see the downswings with more volume and ticks and delta than the upswings. Okay, now from 47.50, as we get to 47.50 here, we start up this move to 13.51. Okay, and looking at the chart, you have to say, looking at the chart, that looks like the market bottoming out. It does look like a reversal, but if you look down at the delta, is the delta shifting up considerably there? Do we have a significant amount of volume in these swings up? Do we have a significant amount of size in ticks in one of the swings up? And right now you have to say no. So at this point, okay, it could be a reversal, but at this point, the order flow is really not telling us that this market is reversed. Okay. And this is how it played out. Basically, we had another leg down to 45, and eventually we reversed up. Now, this is where it gets kind of ugly, okay? Because really, this area here, we don't know it's a reversal until, perhaps this area here when we're about 13.49, okay? So in this case, what we've got, when we go to 45, we've got a case where we've got our low of the day, and we've actually overshot the low of the day. And now we were reversing back through what the low of the day was. Okay, so we'd failed to get to the daily high, but we'd shot through the daily low. Now on this reversal up, we don't really have a big shift in the delta until we get to this point, the move up to 13.49. At that point, the delta's up about 15,000 contracts. Then that is also the first point where we see the delta and the volume in the swing and the swing size confirming a move up. Now, if we look at the pullbacks, we can see that the pullbacks are kind of, they are lower in size. We don't have the delta. You might have got wiggled out in this area here. You got your first pullback there. If you were very tight with your stop, you got wiggled out of your trade. But you can see that generally speaking, as we move up, the volume is on the upside, the size of the swings is on the upside, the delta is on the upside. Okay. And basically, that is how I use cumulative delta. That is what I think the best use of cumulative delta is. Okay, so I think cumulative delta is good for longer term order flow. You could look at this and say, well, look, he's using that on a 900 tick chart. Why don't I put that on a 50 tick chart? And then I can use cumulative delta as a short term order flow tool. Okay, but to me, that still wouldn't make the delta a good short-term order flow tool. And obviously I've tried that, and it just doesn't work well, because I think the nature of the cumulative delta is that it's a zoomed out tool. Now the other thing about cumulative delta, and I'll probably get shot for saying this, it is a good hindsight tool. Okay, now unlike some of the order flow tools, the cumulative delta is going to look the same in hindsight as it does in real time. Okay, so if you actually want to start using cumulative delta, you can load up historical cumulative delta charts, look at the history of how this thing played out, and then start to incorporate that into your methods. With things like the footprint chart, volume profile, you simply can't do that. Okay, so that's one of the benefits of cumulative delta. Okay, so footprint charts, I'm going to say same information, different format. So footprint charts show trades at the bid next to trades at the offer. Okay, so whereas cumulative delta is showing you the difference between the two, footprint charts kind of requires you to work out what the difference is. Now, this is a more zoomed in view, but of course you can put a footprint on a longer term chart. Now, if we're looking for absorption on the footprint, we're going to see a large volume of contracts trading into a price without it being able to move through. And usually that's going to occur at just one or two prices on a thicker market like the ES. We're going to see buyers fade simply by seeing no contracts or very few contracts printing at a price. And sellers coming in, we're going to see price move down and approximately 1.5 to 3 times the size on the sell side to the buy side. Now, in terms of footprint charts, a footprint chart sits on top of a bar chart effectively. So if you can do it, you can do a footprint chart on a 5-minute chart, 15-minute chart, 1-hour chart. If you're going to look at footprint charts, I would say, for various reasons, you should use range charts or point and figure charts. And the reason for that is because we tend to basically, with a footprint chart, we'll go up and we'll come down, and with a reversal, with a chart that shows reversal like a range chart, you'll see the move up on one bar and the move down on another bar. If you use a time-based chart, you're going to see the move up and the move down all in one bar. So effectively, the footprint chart is going to overwrite or add to existing information. So you're not going to be able to say, okay, what happened on the way up, what happened on the way down. So range chart, like a 5 range chart on the ES, a 10 range chart on the crude oil, or point and figure charts, they're the ones that work best with footprint charts because they effectively show you the swings. Okay. So here's a footprint chart. And as you can see, we have pairs of numbers with red and green background. So each pair, the numbers on the left with the red background are sell market orders, and the numbers on the right are the buy market orders. Now, we've also got the delta at the bottom here in 2 formats. Now, once again, the delta is the buy market orders minus the sell market orders, but specific to all of the trading in this bar here. Okay. Now, first of all, what we'll do, let's just take a look at what's happened here. Okay. So what we can see, we've had a move up. And if we look at the move up, you know, at the bottom we've got some size, but on the move up, we've generally seen it's been maxing out 2,000 to 3,000 contracts at each level. When we get up here to where the red arrows are, 42.75, we see absorption on the offer side. So we see this 5,000, nearly 8,000 contracts on the offer side. Okay. And that is absorption. And now, obviously, what you're going to say, looking at that, yeah, but look at the bid side, look at the bid side, 4,000, 6,000, 8,000 on the bid. Isn't that absorption too? And the answer is well, sort of, but there's 2 caveats you've got to kind of consider with a footprint chart. The first of all is there is always 2-sided trading. So whenever there is absorption on the ceiling, whenever the ceilings are absorbing, the buyers don't just stop buying at the same time. So you're going to move up and you will see absorption, a lot of trades at the offer, but while that's occurring, you're still going to see trades at the bid, which is one of the reasons you get size on both sides. Okay. But the other thing is, as we reverse down, okay, you're going to see the sellers jump in size, and that's going to appear on the left side, on the bid side. Okay. And that's going to add to whatever quantity was made on the way up. So what you're seeing here on this bar here, you're seeing the move up and the move down. Okay. And that's one of the problems with footprint charts looking back historically, is you don't get a good handle on what was in the move up, what stopped it, and then what happened on the move down, because it kind of overwrites it. Now the white boxes here represent the close of the bar. So we can see 997 at the top of the last bar, and we can see that we traded down to 181 and closed this bar. Okay, so from this bar here, we only actually managed another 2 ticks up. Okay, and that's what tips us off. So that tips us off where this bar closed is a reason we can fairly confidently say there was absorption here, and then we built volume back on the way down. Okay, so it's not a guarantee, but if you're actually looking at footprints historically, look at where the bars close. Okay, now let's take a look at the white arrows. Okay, so we can see that we peaked up here and we just printed 44 contracts. There's no buyers there. Now it probably just slipped through momentarily. If we had absorption here on the offer side, what you'll find is sometimes there's absorption and they're rebuilding the ceilings and rebuilding the ceilings and rebuilding the ceilings. But sometimes the buyer just momentarily breaks through the ceiling and then they add to the ceiling again and it just gets whacked down. So we can't say at this point categorically that it moved up to there and the buyers faded away, as opposed to we just managed to peak up through a minute because they couldn't rebuild the ceilings fast enough. But over to the right hand side, that is buyers fading away. Okay, so this is the point where we got up, we traded 593 contracts here, but there's no sign of absorption, right? We've just got regular trading at the price below. So we can see we got up there and we probably went up and down there a couple of times, but there was only 593 contracts worth of trades there. There's no buyers there. We're also coming back to the high of the day. Okay, so it's a point where we expect a reversal. Nobody wants to buy into that price. That is the buyers fading away. Okay, and this is also the point where the seller steps in. So if you see the orange arrows pointing at the delta down here, as we moved up, we can see we were getting decent positive delta all the way up. Okay, up to this 4286 over here on the last bar of the move up. All of the buyers up to this point are obviously people that are going to need to sell to unwind their positions if they're still in. Some of them are going to be longer term traders, but generally speaking, we don't care about longer term traders when we're day trading. So as we move from left to right, we're gathering future sellers, but we're just waiting for when are they actually going to turn in sellers? What's going to trigger them to sell? As we get that second attempt to the high, as we've moved kind of sideways here, okay, we can see now minus 266 is pretty neutral on the delta. Minus 1,000 and then plus 1,000, well, those two kind of cancel each other out. Minus 796, minus 1946 on this bar with the right hand side white arrow. It's at this point when the buyers fade that you then start to see a lot more size on the sell side, and we start to see the delta actually going negative. Okay, so there's a couple of places you could have hit into the market here. Okay, you could have hit into the market. An aggressive trade would be to fade the absorption first time to the high. Excuse me. Okay, sorry about that. So that is your first area to potentially enter a short trade. We could have taken a short trade when we had the additional confirmation of coming back to that high, when buyers have got no interest at this double top, or we could have got in when we saw this delta go negative, when we actually saw the sellers come in down here and start to push the delta negative. So that's kind of how you can use that. And you should be able to get a feel how you can play aggressively with an early entry and less aggressively based on the footprint chart, based on the flow of other traders. Okay. Now this is a slightly different type of reversal. So what we're looking at here is a move up and then a trading range that took almost an hour to resolve. So if we look at the orange arrows here, we can see that up to this 1, 2, 3rd bar, we had fairly decent volume hitting into the bid, but on the 4th bar, it's gone. The buyers disappeared. Okay, oh, sorry, this side here, the buyers disappeared. Okay, let me just say that again. On the move up, we had good volume actually on both sides, but in this 3rd bar, we've got the volume effectively disappearing. And then we saw 287 contracts trade at the high. Okay. Then a few minutes later, 49 contracts trade at the high. There are simply no buyers at this point in time interested in trading those prices. Okay. Now, if we look at the red arrows, we can see that we pushed up to 1 tick below the high and printed 177 contracts. Again, no buyers there. Now, I can't say what happened first. okay? But I'm going to take a guess and say that this red arrow, okay, this 5,328 contracts trying to eat the floor was an attempt to hold the market up, which failed. Okay, and I say that just because I've read a lot of footprint charts, and that's what I'm guessing happened. I'm guessing that as we came up, we came back down here, and the bidders, the floors firmed up, a lot of contracts traded, and then they just let it go. Now, after that failed attempt, okay, the market broke downside. So what we've got is a failure to get to the high, looks like a failed attempt to hold it, and then the market breaks downside. We can see in the last two bars, the delta starts to get a lot more bearish as the sellers stepped in and started to push the market down. And of course, the buyers get out of the way because they realize that they're toast effectively. Now, in this example, while we do have sellers stepping in, this is a trading range and it's not a huge range, okay? So you've got to use your discretion a little bit here, okay? So should you fade the top of the range when you see the buyers aren't interested, or should you wait for the sellers to step in? Because if you wait for the sellers to step in, you're potentially going to be shorting in the middle of this range, okay? So when you start to look at order flow, yeah, it's great to see sellers step in and it's great to have that additional confirmation, but you can't just put good trade location to one side because you're using order flow. You do have to combine this with actually entering in a decent place. So in this case, I would actually say seeing the sellers step in here isn't a good trade. It is extra confirmation, but you're still getting in the middle of a trading range. And there's nothing to say you're guaranteed the range will break. Now we're going to cover the footprint a lot more in the second webinar we do. But for now we can see that it's showing the same information as the cumulative delta. But the issue with footprints is they're just not as useful historically, because we might go over fresh ground as we move up, but on the way down we're going to add to existing footprints that were created on the way up. And so we're going to kind of see the final result rather than how it developed over time. So the footprint is quite unique in that it's actually a tool, an order flow tool, that's easier to read in real time than it is in hindsight. Okay, so the next order flow tool, the order book. Okay, now the main difference between the order book and the delta and the footprint chart is that the order book actually displays the intent. It displays the floors and ceiling. It displays the limit orders. The cumulative delta don't display the floors and ceilings, but it's merely implied how thick a market was by that price delta relationship. If the delta moves up and price doesn't move up, you know that the ceiling was thick. Okay, you know that there was more liquidity eaten on the way up. Now, decent order books like Xtrader, CQG, and of course Jigsaw will show you the trades that executed. Now, any DOM that doesn't show you or give you a good view of actual trade execution might be a good order entry tool, but you won't find it a good order flow tool. Let's just bring across a DOM. Okay. So here's the Jigsaw Trading DOM, okay, and what we can see here, just center that, the columns here where my cursor is, that's actually the trades actually occurring in the center. So we've got trades at the bid here where we see the 31 little pink one, those are the trades that are eating the floor, and the green 55 here, those are the trades that are eating the ceiling. Okay, now a lot of people say that depth of market is useless because of the amount of manipulation that goes on. And it is true that the market depth is manipulated with people putting in really large bids and offers and making the floors and ceilings look really thicker than they are, but that doesn't make the DOM useless. Okay, so if you think about it, why would somebody go to the trouble and risk of putting in orders that they don't want to fill? okay? Because you can't put this guy down here with 1,500 contracts, whether he's fake or not. If he's spoofing, right, he actually has to have the account size to put in 1,500 contracts. Now, of course, it's not all one guy, okay? But if he's spoofing and the market comes down and he doesn't get out fast enough, he has to honor those contracts. He has to buy those contracts. So there is a lot of risk to spoofing. And the reason that they spoof the market is because that spoofing, that manipulation pays off. And that's effectively why this information is useful, because people are playing games with it and you can watch them play the games and you can use that information in your trading. Now, obviously what we can see here in this blue column are the floors, and what we can see in the red column are the ceilings. Okay. Now, in terms of manipulation, we can actually see in the outer blue and red columns the pulling, the stacking activity in what we call the snapshot. Now, this is kind of neat to watch. So I can see basically they've added at 1837, they've added just over 230 contracts right now. Okay. But the thing is, you can get kind of caught up in all of this pulling and stacking activity. The most important information, even when you're looking at the DOM, is the trades that are actually executing at each level. Now, the DOM is very much a right here, right now tool. Okay, so it's most beneficial at refining an entry or assessing if a trade is on side just after you've entered. Okay, there's very little history on the DOM. Okay, you see what's happening right now. Now, to the outside here, we do have a volume profile, and that is actually showing us history for the whole day. And here we do have a kind of split volume profile, which effectively is similar information that you see in a footprint, telling you how many trades hit at the bid here and how many trades hit at the offer here. Okay, now with all these different profiles and all these different numbers, there's a lot of numbers on the screen, and one of the issues that people have is they say, I can't read the DOM. There's too many numbers on it. It moves around too much. Now, I would agree that it would be very difficult to read all of those numbers at the same time, and you don't actually need to. Okay, so the mistake that people make when they start to look at the DOM is they try and read the whole screen. I don't think there's many human beings that could do that. Okay, so you don't need to look at all the information all the time. So for instance, the volume profile helps you to see where other traders are currently positioned. And knowing where other traders are positioned, that gives you a trade location. Then the ebb and flow of the orders being executed gives you an idea if the market is actually holding in that trade location or actually powering through it. Then at the point you decide to say, I'm going to go long, excuse me. Sorry about that. If you want to go long, then you might decide, okay, I'm going to go long because I'm in a location. I can see that the order flow here is telling me that it might be good for a long trade. So now what I'm going to do, I'm going to look at the offers and I'm going to say, okay, I've got 700 offered there. I'm not going to go long into that until it drops down to 300, until it looks like the offers are about to break. Okay, so you never have to look at all of the information at the same time. And in fact, what many people will do, they'll actually, switch off a lot of the columns. Okay, but the mistake when you're using the DOM is to try and use everything at the same time. Okay, so it's not about being able to process hundreds of numbers all at one time. Now, in terms of the elements of a reversal, okay, absorption is very easy to spot. You will see a lot of contracts hitting into a level, and if we look at this here as it moves down, we can see, on average, we've got 300, 150, 600, we've got 2,000 here contracts that hit into the bid. So we can say, okay, 2,000 is the high end, 1,300 still decent. So if we were looking for absorption now, we'd probably be looking for 3,000 contracts or more to hit into an offer or a bid and price not moving. Okay. Now at the same time, when you're looking for absorption, you're probably also going to see some high numbers here, which is the column that tells us they're actually adding more orders. Okay. Now, buyers fading, you're often going to get to a point where just a few contracts hit. Okay, and you're probably going to revisit that point several times. So the things that you're going to see on here is you're going to see we get to a price, nobody trades, and then it moves up. Comes back to the price, nobody trades, and then it moves up. But there's a pause. Okay, as this occurs, you're going to see it gets, and there's a pause. It doesn't start moving away straight away. Okay, so for instance, we've just seen 28 contracts here. Okay, if this is buyers fading away, we'll see it come back, and there'll be a pause. And the reason there's a pause, it's as if it's palpable, the dawning of realization on behalf of those last sellers that they're the ones left holding the bag. Okay, so when you see buyers fade, okay, or sellers fade, you can see if it comes down again and just a few contracts trade, all of the other sellers are going to see that. And eventually they just bail and move out of the way. Okay. Now, in terms of, seeing the other side jump in, very similar to the front footprint, you're going to see the market move down to an area, and then suddenly you're going to see some large size hit into here. And the reason you're actually going to see the large size is these ceilings here won't have a chance to get out of the way. So if buyers jumped in right now, you could expect to trade like 500 at this level, 1300 at this level, 1200 at this level, because they'll just come in and whack it. And even if these guys here with the like 1300, 1200 contracts, even if they're not real, they just won't have time to get out of the way if buyers jump in. Now, if order flow is the icing on the cake, then the manipulation, the pulling on the stacking, could perhaps be called as the icing on top of the icing on the cake. Okay, so we can see now average depth on the first couple of levels is below 1,000. Everywhere else is about 1,000. We've got this level here at 1834, where we've got like 1,500 contracts. But we said at any support level, we're going to see the bids higher than the offers. So when we see that large size there, that doesn't mean they're going to hold the market, and we can't read too much into it. Now, if we were moving up, say nobody, say the buyer, this is a reversal, the sellers realize nobody else is going to sell now, and we start to move up, and we move up 3, 4, 5, 6 ticks, and then suddenly on the bids below us, we see 3,000, 4,000, 5,000, that kind of size below us, okay? That absolutely screams manipulation, right? Manipulation on the dome, stacking on the dome, isn't having an average of 1,000 contracts and somebody putting 1,050, right? They want you to see it. They want you to see a big number. So if you're not sure if it's spoofing, then it isn't, okay? But if you see it move up 5 or 6 ticks and then you see 3,000, 3,000, 3,000 right behind you, very likely in the market, if just in the very short term, it's very likely the market's going to actually move down. Because what you'll see is as the market moves up, if you see huge stacked orders below you, then the chances are the market's going to collapse because they're fake, and that's just some guys who are trying to exit a position. And they're trying to exit a position by stacking the bids, getting you to buy, leaning on those bids, and you're buying off them because they're actually the ceiling, okay? And when they're done, they'll pull those bids and the market will drop down, okay? But I would say if you're using order flow, you could quite easily use order flow without ever having worried about bids and offers, okay? It is optional. And I'll just show you one more way of actually looking at the same information. This is still short-term information, but just kind of a bit of fun. These meters here are also another way of seeing order flow. So the left-hand side is showing you the trades at bids and offer, which is effectively these central columns. The middle one is showing you the depth, the actual bids and offers. It's just showing the first three levels. And the one to the right here is showing me the changes to the depth. Okay, and again, it's just another way to look at order flow. It's just another way to look at the DOM information. It is also very, very, very short term. Okay, there is no history with this. It's right here, right now. Okay, so we have one more order flow tool to look at. Now, with all the order flow tools we've looked at so far, they've got one thing in common, right? They might show the sum total of the trades on each side, but none of them show the individual size of the trades themselves. Now, with the time and sales, you see the individual trades. And you also get a great feel for the pace of the market. And like the DOM, it is a right here, right now, ultra short term order flow tool. This is not something you're going to use to analyze the overall state of the market and tell what's going to happen in the next 3 days. Okay, this is confirming an entry and confirming the order flow is on your side after the entry. Okay, and the premise is, if you see 1,000 contracts trade, would it not be nice to know if that was 5 200 lot trades or 500 2-lot trades? Because personally, I'd rather trade with 5 200 lot traders than with 500 2-lot traders. Okay, which brings us to a small problem with a lot of time and sales products. And that is, in October 2009, the smart programmers at the CME, and kind of by extension all of the exchanges that the CME owns, such as NYMEX and CBOT, decided to change the time and sales. Now, prior to these changes, if somebody submitted a 1,000-lot order, then it would show up as a 1,000-lot order on time and sales. Then the CME, in their infinite wisdom, decided to change that so it reports one trade per limit order it was filled against. So if someone submits a 1,000-lot trade and it gets filled against 500 2-lot limit orders, you're going to see 500 lines on the time and sales, or rather, you would see 500 lot trades, 500 trades if you had a 90-inch trading screen. Okay, what you'll actually see is a flood of trades, pages and pages of trades going by that you can't read, and it is actually fairly useless. Now, what we did at Jigsaw, and what a few other people have done as well, there's various methods of aggregating time and sales. Now, at Jigsaw, the approach we took is to actually reverse engineer the October 2009 changes, and so we try and show the actual 1,000 lot order that was submitted. Okay, and we're with the CME marks, we're about 95% right. Okay, so what about the 3 elements of a reversal? And let's just bring across the time and sales. Okay, and this is a time and sales. There's 2 time and sales here. One is showing all trades. One is showing just the large trades. Now, one of the things about time and sales, it actually shows the time of the trade, and it shows the full price. If you've got an option, you don't really need the time of the trade. If you're seeing trades go past at 100 miles an hour and it slows to 1 trade a minute, that's something very interesting. But you're going to see that just in the pace of the time and sales. So I would advise not showing too much information on the time and sales. All you really need to know is the price and the number of contracts. Now, on this particular time and sales, the price is actually 1834.75, but we actually I like to actually kind of chop off the first 2 digits, again, just to make it easier to read. So what are we going to see in terms of the 3 elements of a reversal? Okay, so the first element of a reversal is absorption. And with absorption, you're going to see a stream of prints, mostly on one side, okay? And so let's talk about absorption on the ceiling, or on the limit order, on the offer side, where we've got buy market orders buying into the offer, okay? So we're going to see prints, green prints, and we're going to see all those prints at the same price. Okay, so we can see buy market orders, but the price not changing. Now, obviously, what's going to happen is you're still going to get some red prints, but as the absorption, as we're moving up, we're going to have overall in an up move, you're going to have overall more green than red, and you're going to see that green continue, but the price will just keep printing the same price. So that's the absorption. Now, the buyer's fading up to a point as you move up, you're going to see mostly green. Okay, it will always be a mix, but it will be mostly green in a move up. And then suddenly the green prints stop coming. Now, you might print green again as the price comes down, but you'll see that there is a clear maximum green price. Okay, there's a maximum price that green will print at. Okay, and you'll get up to that price. Green might print a couple of contracts, but you'll only get red printing at the price below. And those that printed at the maximum price are the ones trapped in bad positions that help the move down. Now, the other thing is, don't expect only little guys to get trapped. Okay. Now, the other sign of a reversal is sellers stepping in. Well, that's pretty easy. We'll be moving up with mostly green, and then we're going to see a sudden rush of red prints with prices moving down as a result. Okay, it's not enough to just see the red, because when sellers step in, they could get trapped. Okay, so you need to see the selling come in and price progression downwards. Okay, so just seeing sellers step in is if you see sellers coming in, lots of red prints, but price doesn't move down, that's brilliant in terms of getting an entry price, because you see the willing on the behalf of the sellers. You see they're willing to come in, but if they're not getting any price move down, it's just too dangerous to enter on that. Because if there's no price progression downwards, sure, you've got confirmation that the sellers are there, but you've also got the bid side absorbing. You've also got the floors refreshing. Okay. Now, time and sales has got the least history of any order flow tool. Okay. It's as much about pace as anything else. It's not everybody's cup of tea. Okay. But what I will give you is probably the best use of the time and sales for a beginner. Okay. So the best use of time and sales for a beginner is just this. It's just the large trades. Okay. So on the ES, I would recommend that you take a tape showing contracts of 100 lots or more. Okay. And what you're going to look for is, as you move up, you're going to occasionally see groups of large green prints. Okay. So in a move up, like we're doing now, in a move up, you're not going to see big prints every price. Okay. You're going to see like 100, 100, 100. And then, okay, we've ticked up. Okay, 36.50. And then you'll see some more big ones come in and we'll move up. And then some more big ones come in and we'll move up. And what you'll see after a while, okay, in fact, what we can see right now is that we can see we've got these large traders here, 486 at 36, all the way up to 36.50. And those large traders right now have not got anything for their money. Okay. And this is one of the things, if you combine with a good trade location, that you want to look out for, because you should see large prints move up, large prints move up, large prints move up. And then when you get the large prints and no tick up, okay, and then this pause, which we can see now, is those sellers, okay, some of those buyers will be short-term buyers, okay, and there's a pause. And it's sinking into these guys that they possibly just bought a short-term high. Okay, so after large prints, no move up, a pause, which can be 1 or 2 minutes, you're going to see suddenly the other side's going to come in and back the price down. Okay, now that doesn't mean you do this, in the middle of the market. It doesn't mean you do this in the middle of a trading range. You still need to do this at an extreme. But actually what we're seeing now is exactly what you'd want to see for a short trade based on buyers being trapped. Okay, and I'm going to leave that up there just to see how it plays out. Now, what I wanted to do was I wanted to actually talk some more about volume profiles and volume clusters. But I've taken up a lot of time right now. We will run out of time if I go on to talk about volume clusters. So what I'm going to do is I'm actually going to record for you a short 30-minute video on volume profile and volume clusters, because I think that does complete the picture and it does answer one of the questions. But for now, let's bring it to a close. We've covered a lot of material today, but I hope the message of liquidity consumption, floors and ceilings, helps you to understand what order flow is all about and what is common between all these tools. Now, order flow does require a lot of discretion. It's a discretionary tool, okay? It's like reading a story, okay? It doesn't mean you trade it without rules. It just means that every situation is going to be a little bit different, but the overall patterns will be recognizable with practice. So with that, let's end there. I'll get you the other video. And Eddie, do you want to do some more questions?
Okay, sure. If you do have any questions, post them in the lounge. I'm just scrolling up right now to make sure I missed it. Peter, excellent.
Yeah, I appreciate that as well. Thanks, guys.
If you have any questions, please post them in the lounge. We've got a few more minutes, and we'll make sure that first. So let's start with Fred. Fred's got a question. Question for Peter. Something I've heard in market profile terms in discussing order flow. Can you talk a little more about how the combine market profile and order flow together? If I'm correct, it's the balance of market order.
Absolutely. I use market profile. I actually have a blog on TopStep where I put my pre-market prep every day and say what I think is going to happen to the market. I absolutely use market profile for longer term analysis, and it puts in I use a lot of market profile for setting the levels I'm going to trade off intraday. I tend not to use the market profile itself intraday, but what I do use is auction market theory for trading ranges. And actually that was what if I hadn't run over so much today, that was effectively what I wanted to talk about next. It's what we talked about in the last webinar, trading without charts. But I'm going to do a video on that, on effectively what happens, how the market moves in terms of ranging, and then trending ranging behavior intraday. But that is all part of market auction theory. So I hope that answers it.
Price got a question. While analyzing order flow, you pay attention to your states in order to better identify who's getting ripped off in the market.
My state, I'm not sure what you mean by my state. I do absolutely do that. I tend to not worry about that so much at entry time, but I do worry about it when I'm in a trade. And by that I mean, if you want to look at an ideal place where people are getting ripped off on the market, you have a trading range, you go to the top of the trading range, and sellers start to fade the top of the trading range, and you come down, and the bids are stacked. The offers are stacked. It looks really weak, but there's iceberging. You get 2 or 3 ticks down off the top of the range, and there's an iceberg order absorbing contracts. Then they pull that iceberg order, it ticks down again, but they start absorbing there. And what's happening is they're making the market look weak, but they're absorbing all the contracts by buying, and then they'll move it up. Now I can see that, and if I'm on the wrong side of that, I will exit. But I don't enter trades. I don't join the manipulators. I'm not comfortable doing that. So I kind of I'm aware of it, but I don't join in with it basically.
Next question. Fred again. I've heard order flow described as only useful for scalping type trades. How would you respond?
Yeah, I call it the icing on the cake. So the cake is whatever method you use to define a trade location. That could be with charts or without charts. And then the order flow is basically lets you see, okay, right here, right now, at this location, am I seeing behavior which is indicative of a reversal or a continuation, depending on how I trade? So I agree that scalpers, I've never heard of a scalper that doesn't use order flow, but I know a lot of position day traders that use order flow as a confirmation tool. Mm-hmm. No, it's in webinars 2 and 3. This was just an introduction. I know there was a lot covered, but this was just the introduction. So we do more specific in the other webinars.
This webinar, the introduction, 2 hours. The next webinar is 2 weeks.
Yeah. No, we've done all the heavy lifting in this one, basically.
You get to move in with
Yeah. I think Kaj has got one. Kaj 15 has got a question. Okay, he's asking if there's a platform that shows order flow plus implied volatility. I don't know. I don't use that myself, so I don't know. In general, that's kind of proprietary information. Everybody wants to figure out how we're doing that, but I'm not going to tell anybody.
Vance's got a question. Next webinar is 2 plus 2 weeks.
I think we've got one next Friday, I believe. Yeah.
I did mention to a lot of people that we do get this information with our Facebook account, yes, this with our Twitter account. If you'd like to get on the mailing list for all our educators and open chance to guests, just contact support at TopStepTrade.com. Tix is going to follow up on a question. His first question was, how do you know when to start large orders?
Yeah.
Chris just put a link in there for Peter's website, jigsawtrading.com, and there's some other material posted in his website. Check out Peter. Speaks to me,
Yeah, right. I think we got one more question from Zed. Okay, and I got that. I got a message on PM as well. Yeah, that's something called Gomi Tools, which is available on the Big Mike Trading Forum. He's got an elite section over on the forum with a lot of free downloadable tools, and that's what I'm using basically. Mm-hmm. Excellent. Well, thanks, guys. Thanks for coming, and I'll speak to some of you on Tuesday when we do our session then. Will do. You too. Bye.